ExamPrep.School. NC Life Insurance Exam, exam code INSNC-Life01. There are 5 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Annuities. North Carolina statutes and regulations pertinent to life. Other life topics. Policy provisions, options, and other features. Types of individual life insurance. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which characteristic is specific to a decreasing term life insurance policy? A. Premiums increase annually to maintain a level face amount. B. Premiums remain level while the face amount declines over the coverage period. C. Premiums and face amount both decrease as age increases. D. Premiums decrease over time, with face amount remaining constant. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is B. The correct answer is that a decreasing term policy maintains a level premium, while the death benefit steadily declines over the policy term. Reason A is not correct. This describes annual renewable term where premiums rise to keep benefit level. Reason C is not correct. Premiums do not decrease in decreasing term policies. Only the face amount declines. Reason D is not correct. A decrease in premiums with a constant benefit is not a feature of standard decreasing term policies. Question 2. Under an annual renewable term life insurance policy, how are premiums typically structured? A. Premiums remain level throughout the coverage period. B. Premiums decrease annually to reflect insured's accumulating age risk. C. Premiums are level for the initial term and then reset to a higher level at each renewal. D. Premiums increase at a fixed rate each policy year. The correct answer is C. The correct answer is that annual renewable term policies set level rates for 1-year intervals, with each renewal reflecting the insured's attained age and resulting in higher premiums. Reason A is not correct. Level premiums throughout a multi-year period apply to level term, not annual renewable term. Reason B is not correct. Premiums do not decrease. Mortality costs increase with age, raising premiums. Reason D is not correct. Premium changes are based on age-specific mortality, not a contractual fixed percentage. Question 3. Under a standard convertible term policy, the conversion privilege typically remains available until the insured A. Misses a scheduled premium payment. B. Completes the initial premium holiday period. C. Reaches the maximum age specified in the policy's provisions. D. Exercises a non-forfeiture option. The correct answer is C. The correct answer is that the conversion privilege generally expires when the insured attains the maximum age defined in the policy, even if the term period has not fully elapsed. Reason A is not correct. A missed payment may lapse the policy but does not define conversion windows. Reason B is not correct. Premium holiday periods are unrelated to conversion eligibility. Reason D is not correct. Non-forfeiture options apply at lapse, not conversion privileges. Question 4. Which provision allows the insured to convert term life insurance to a permanent policy without evidence of insurability? A. The extended term non-forfeiture option. B. The reinstatement clause following policy lapse. C. The incontestability clause after 2 years. D. The conversion privilege for amounts up to the original face amount. The correct answer is D. The correct answer is that the conversion privilege typically permits conversion to a permanent policy without proof of insurability, provided the new coverage does not exceed the original face amount. Reason A is not correct. Extended term non-forfeiture provides temporary coverage, not conversion to permanent. Reason B is not correct. Reinstatement requires evidence of insurability and is not a conversion feature. Reason C is not correct. Incontestability relates to contest periods, not conversion rights. Question 5. In this scenario, what must the insurer require to renew the policy under the original terms? A. Automatically renew the policy at the attained age premium without requesting new evidence. B. Guarantee renewal without evidence at a higher premium rate tied to current age. C. Offer conversion to a permanent plan upon renewal, regardless of health status. D. Require satisfactory evidence of insurability before approving renewal under original policy terms. The correct answer is D. The correct answer is that the insurer must require evidence of insurability before approving renewal under the original terms, because re-entry term policies include a provision that conditions level term renewal on satisfactory proof of insurability. Reason A is not correct. This describes guaranteed renewable coverage, not a re-entry term which requires proof of insurability. Reason B is not correct. Re-entry terms do not guarantee renewal without proof. They require evidence even if premiums would be higher. Reason C is not correct. Conversion privileges permit changing policy forms, but renewal under a re-entry term depends on insurability, not automatic conversion. Question 6. Which best describes the benefit and premium structure of this rider over the 25-year period? A. Both the death benefit and the premium decrease annually over the 25-year period. B. The premium decreases each year while the death benefit remains level until the rider matures. C. The death benefit decreases annually while the rider's premium remains level for 25 years. D. The death benefit remains level and is convertible at maturity without requiring evidence of insurability. The correct answer is C. The correct answer is that the death benefit decreases annually while the term rider premium remains level for its 25-year duration, matching mortgage amortization without premium fluctuation. Reason A is not correct. Term riders under a decreasing structure only reduce the benefit, not the premium, which stays constant during the term period. Reason B is not correct. This reverses the actual mechanics. Benefits decrease while premiums stay level rather than the opposite. Reason D is not correct. Decreasing term riders provide a reducing death benefit. They do not maintain a level benefit or allow conversion without insurability evidence. Question 7. In this scenario, what amount should the insured expect to receive from the insurer? A. Net premiums paid after dividends have been credited to the policy's cash value. B. Total premiums paid minus cost of insurance charges, fees, and policy expenses. C. All gross premiums paid during the 20-year period if no death claim has occurred. D. Total premiums paid less any dividends used to offset the cost of coverage. The correct answer is C. The correct answer is that return of premium term policies refund all gross premiums paid at term expiration, provided no claim has been filed, since they are designed to return premiums without regard to charges or dividends. Reason A is not correct. Term policies do not accumulate dividends or cash value, so net premiums after dividends do not apply. Reason B is not correct. Return of premium policies refund gross, not net, premiums. Charges and fees are not deducted from the refund. Reason D is not correct. No dividends are used to offset coverage cost in term policies, so premiums are not reduced by dividends. Question 8. Which statement best describes the premium payment pattern under the level premium structure of an ordinary whole life insurance policy? A. Premiums are only required until the insured reaches age 100, then they cease. B. Premiums increase annually to match rising mortality costs as the insured ages. C. Premium amount is fixed throughout the life of the policy, with early payments subsidizing later years. D. Premiums decrease after the cash value equals the policy's face amount. The correct answer is C. The level premium structure keeps the premium constant over the insured's lifetime. Early premiums exceed mortality costs and build cash value to cover higher costs in later years. Reason A is not correct. Premiums for ordinary whole life do not cease at age 100. They remain level throughout life. Reason B is not correct. Mortality costs do increase with age, but level premium does not adjust annually to match them. Reason D is not correct. Cash value never equals face amount in whole life, and premiums do not decrease afterward. Question 9. In a 20-payment limited pay whole life policy, which statement is accurate regarding premium payments and coverage? A. Coverage terminates at the end of the 20-year payment period. B. Premiums increase each year after the 20-year period to adjust for inflation. C. Level premiums are paid for only 20 years, after which the policy is fully paid up for life. D. Premium payments cease at age 65 regardless of the chosen payment schedule. The correct answer is C. Limited pay whole life requires level premiums only for the specified pay period, after which no further premiums are due and full coverage continues. Reason A is not correct. Coverage does not terminate after paying. Only premium obligations end. Reason B is not correct. Inflation adjustments are not part of limited pay structures. Premiums remain level only during the pay period. Reason D is not correct. Ceasing payments at age 65 describes life paid up at 65, not a specified 20-pay plan. Question 10. Which characteristic most accurately describes a single premium whole life insurance policy? A. Level premiums are paid over a predetermined period until age 65. B. A single lump sum premium provides permanent coverage and immediate cash value. C. Premium payments stop once the cash value equals the death benefit. D. Policyholder may vary premium amounts within limits based on current interest rates. The correct answer is B. Single premium whole life requires one lump sum payment at issue, which fully funds the policy, providing lifetime coverage and begins with immediate cash value. Reason A is not correct. Paying over time describes limited pay or life paid up plans, not single premium. Reason C is not correct. Cash value never fully equals death benefit under whole life and coverage continues. Reason D is not correct. Flexible premiums describe universal life, not single premium whole life. Question 11. Which statement best describes the premium pattern of a graded premium whole life policy? A. Policyholder chooses annual premium amounts within a guaranteed range. B. Premiums remain level for a few years, then increase once and stay constant thereafter. C. Initial premiums start lower and increase periodically over a set period before leveling off. D. Premiums adjust annually based on insurer's mortality experience. The correct answer is C. Graded premium whole life features. Premiums that begin at a lower amount and increase at scheduled intervals until reaching a level amount for the remainder of the policy. Reason A is not correct. Flexible choice of premium is a feature of universal life, not graded premium whole life. Reason B is not correct. A single-step increase describes modified premium, not graded premium. Reason D is not correct. Annual adjustment for experience applies to adjustable life, not graded premium whole life. Question 12. John purchased a 20-year endowment life policy with a face amount of $100,000. When this policy matures at age 65, which benefit will he receive? A. The policy's face amount as the maturity benefit. B. The policy's cash surrender value at that time. C. Any accumulated dividends taken as paid-up additions. D. The guaranteed cash value at the maturity age. The correct answer is A. An endowment life policy pays the full face amount as the maturity benefit at the endowment age, not the cash surrender value or dividends. Reason B is not correct. A cash surrender value applies if the policy is surrendered before maturity, not at endowment maturity. Reason C is not correct. Accumulated dividends taken as paid-up additions are separate from the guaranteed maturity benefit. Reason D is not correct. The guaranteed cash value schedule applies prior to maturity. At endowment age, the full face amount is paid. Question 13. Mary purchased a whole life policy containing a guaranteed cash value schedule. At the end of the 15th policy year, she surrenders the policy. Which amount is the minimum guaranteed payment she will receive upon surrender? A. The guaranteed cash surrender value shown in the policy schedule. B. The current cash value including dividend additions. C. The policy loan value available at the time of surrender. D. The extended term insurance value under the non-forfeiture option. The correct answer is A. The guaranteed cash surrender value schedule specifies the minimum amount payable upon surrender, regardless of dividend performance or loan provisions. Reason B is not correct. Dividend additions are non-guaranteed and do not form part of the guaranteed minimum surrender value. Reason C is not correct. The policy loan value is not the same as the guaranteed cash surrender value. Reason D is not correct. Extended term insurance values depend on dividends and are non-guaranteed non-forfeiture options. Question 14. Which statement best describes the flexible premium feature of a universal life insurance policy? A. It requires payment of a predetermined annual premium amount with no deviation allowed. B. It permits the policy owner to vary premium payments within contractual minimum and maximum limits. C. It mandates level premiums equal to the annually recalculated target premium. D. It limits premium deposits to a single lump sum at inception with no additional funding. The correct answer is B. The correct answer is that universal life policies allow the policy owner to adjust the amount and timing of premium payments within the policy's specified minimum and maximum limits. Reason A is not correct. Universal life is designed to allow variation in premium amounts and timing, so it is not limited to a fixed annual amount. Reason C is not correct. The target premium is a guideline, not a mandatory level. Premiums can be above or below that target within the allowed range. Reason D is not correct. Universal life permits multiple premium deposits over the policy's life, rather than only a single lump sum at issue. Question 15. In a universal life insurance policy, the target premium is best defined as A. The minimum payment required to maintain the policy's non-forfeiture value. B. The recommended premium amount calculated to keep the policy in force under current cost and interest assumptions. C. The maximum allowable payment before the policy becomes a modified endowment contract. D. The payment equal to net single premium plus expense load that fully funds the policy. The correct answer is B. The correct answer is that the target premium is the suggested level of premium designed to keep the policy in force based on current cost of insurance charges and credited interest assumptions. Reason A is not correct. The minimum payment maintains non-forfeiture values but is not the target premium, which is a recommended, not required amount. Reason C is not correct. The maximum payment before MEC status is a limit on funding, whereas the target premium is a guideline for adequate funding. Reason D is not correct. Net single premium plus expense loading refers to a single premium policy calculation, not the ongoing target premium. Question 16. Under a universal life contract, cost of insurance charges are calculated by applying the mortality rate to which of the following? A. The net amount at risk, defined as the difference between the death benefit and cash surrender value. B. The policy's target premium adjusted for anticipated interest earnings. C. The accumulated cash value at the start of the policy year. D. The total face amount divided by the current expense loading factor. The correct answer is A. The correct answer is that cost of insurance charges are based on the net amount at risk, which is the difference between the death benefit and the cash surrender value, applied to the mortality rate per unit of risk. Reason B is not correct. Target premium influences funding recommendations but is not used to calculate mortality charges directly. Reason C is not correct. Cash value is not the basis for mortality charges. Only the net amount at risk is considered. Reason D is not correct. Expense loading factors apply to premium allocations, not directly to mortality charge calculations. Question 17. A policy owner holds an interest-sensitive whole life policy with an accumulation value of $50,000. The policyholder has an outstanding loan of $5,000 and faces a surrender charge of $1,000. The insurer's current reported cash surrender value is $44,000. What best explains why the cash surrender value is lower than the accumulation value? A. Because accumulation value includes credited interest, but does not reflect deductions for loans and surrender charges. B. Because cash surrender value subtracts the outstanding loan balance and the surrender charge from the accumulation value. C. Because cash surrender value represents only the amount applied toward the cost of insurance and excludes accumulated interest. D. Because accumulation value excludes any dividends used to purchase paid-up additions. The correct answer is B. The cash surrender value equals accumulation value minus any outstanding loans and surrender charges. Therefore, it is lower than the accumulation value. Reason A is not correct. Mentions accumulation value ignores deductions, but this does not explain why cash surrender value is lower. Reason C is not correct. Mischaracterizes cash surrender value as covering only cost of insurance, which is incorrect. Reason D is not correct. Introduces dividends that are unrelated to the difference between accumulation value and cash surrender value. Question 18. A 45-year-old insured has a universal life policy with a specified face amount of $100,000. After 10 policy years, the cash value has grown to $20,000. How does the net amount at risk differ between death benefit option A and option B at this point? A. Under option A, the net amount at risk is $80,000. Under option B, it is $100,000. B. Under option A, the net amount at risk is $100,000. Under option B, it is $80,000. C. Under option A, the death benefit increases to $120,000. Under option B, it remains at $100,000. D. Under option A, the net amount at risk remains level. Under option B, it decreases over time. The correct answer is A. Option A's death benefit remains level at $100,000. So net amount at risk equals face minus cash value. 100,000 minus 20,000 equals 80,000. Under option B, death benefit equals face plus cash value. 100,000 plus 20,000 equals 120,000. So net amount at risk equals 120,000 minus 20,000 equals 100,000. Reason B is not correct. Reverses the amounts for net at risk under each option, which does not match the calculations. Reason C is not correct. Misstates option A's death benefit increase and fails to address net amount at risk correctly. Reason D is not correct. Incorrectly describes the pattern of net amount at risk under both options. Question 19. At year 8 of a universal life policy, the accumulated cash value is $150,000, and the death benefit is $160,000. The quarter requirement at the insured's current age mandates a minimum ratio of death benefit to cash value of 130%. Which action must the insurer take to comply with this requirement? A. Require the policy owner to increase the death benefit to at least $195,000. B. Reduce future credited interest to lower the accumulation value. C. Reclassify the excess as a modified endowment contract and impose penalties. D. Convert the policy to a term policy until the corridor requirement is met. The correct answer is A. To satisfy the 130% corridor, death benefit must be at least 130% of cash value. 150,000 multiplied by 1.30 equals 195,000. The insurer must require an increase to meet that threshold. Reason B is not correct. Credited interest rates cannot be adjusted to satisfy corridor requirements. Reason C is not correct. Reclassification as a modified endowment contract is unrelated to corridor compliance. Reason D is not correct. Conversion to term is not a permitted method to meet corridor requirements. Question 20. Which characteristic is exclusive to a variable annuity contract compared to a fixed annuity contract? A. Investment assets in the separate account are guaranteed by the insurer's general account. B. Accumulation values are credited with a fixed interest rate declared and guaranteed by the insurer. C. Contract cash values are maintained in the insurer's general account. D. Accumulation unit values fluctuate based on the performance of underlying separate account subaccounts. The correct answer is D. The distinguishing feature of a variable annuity is that its accumulation value is based on the performance of investments in subaccounts held in a separate account, exposing the contract owner to market fluctuations. Reason A is not correct. Incorrect because separate account assets are not backed by the general account. Guarantees apply only to fixed annuity general account assets. Reason B is not correct. Describes a fixed annuity feature since fixed annuities credit and guarantee an interest rate declared by the insurer. Reason C is not correct. Pertains to fixed annuities which hold cash values in the general account rather than in separate accounts. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.